All right, future finance pros, welcome. Think of this as your personal coaching session for that big SCMP exam. Today, we're going to tackle a really powerful tool, something that helps us measure how a company's really doing. It's called Economic Value Added, or EVA.
So we hear it all the time, right? Profit is king. You see a company post this massive profit and everyone thinks, wow, they're crushing it. But what if that's not the whole story? I mean, what if I told you it's only half the picture? Imagine a company makes, say, $1 billion in profit. Sounds amazing. But what if they had to sink a ton of money to get there? And what if the return they got on that money is actually less than what their investors could have gotten somewhere else? Suddenly, that big profit number, well, it doesn't look so hot, does it? It doesn't really tell you if they created any real value.
And that's exactly where EVA steps in. You can think of it as the ultimate test of value creation. See, EVA tells us if a company is making wealth after you account for the cost of all the money that was pumped into it. We're talking both debt and equity. So you see, it's not just about being profitable. It's about creating genuine, real value for the people who own the company, the shareholders.
Okay, so here's our game plan for today, our coach's playbook. First, we'll get the main idea behind EVA. Then, we'll take the formula apart piece by piece. After that, we'll dive into an exam-style case study, see how it works in the real world, and wrap it all up with a super quick formula recap. Sound good? Let's jump in.
So, what's the big idea here? At its core, it's pretty simple. A company only creates real value if it earns more money than its investors could have made somewhere else with the same amount of risk. It's like, if you give me your money to invest, you expect me to do better than a safe bet, right? Well, EVA measures exactly that. If the number's positive, hey, you're creating value. But if it's negative, well, you're actually destroying value. And this is the kicker. You could be destroying value even if your profit and loss statement shows a profit.
Now pay close attention here, because this is gold for your exam. Think of these 3 points as the strategic moves a company can make to pump up its EVA. These are your exam keywords. First, you can get more efficient, make more profit without using more money. Second, you can find new projects that make more money than they cost. That's profitable growth. And third, you got to know when to fold them. Get rid of projects that are dragging you down and earning less than they cost. Nail these 3 points in your answer, and you're well on your way to top marks.
All right, let's get into the nitty-gritty. It's time to deconstruct the formula itself. Now, when you first see it, it looks pretty straightforward. But trust me, the secret to nailing any EVA question on the exam is mastering the 3 key pieces that make it up.
And there it is. EVA equals NOPAT minus WACC times capital employed. Whoa, okay, lots of acronyms, right? Don't sweat it. We're going to break down every single one of these, NOPAT, WACC, and capital employed, step by step. You'll have it down in no time.
Okay, this is where the rubber meets the road. Time to apply all this to a case study. Because with the SCMP, it's never just about knowing the theory. It's all about applying it. So we're going to walk through this problem for XYZ Ltd exactly how you should in the exam. Nice and steady, one step at a time.
All right, here's the info we're working with. This is what you'd see in the question. We've got numbers for share capital, debt, profit, tax rate, the whole shebang. The trick here, the real skill, is knowing which numbers to grab for which part of the formula. Let's get started with the very first piece of the puzzle.
Step 1. Let's figure out the capital employed. So what is that, really? It's basically all the money tied up in the business for the long haul that, well, that costs something. We're looking for all the sources of money where the provider expects to get paid back and then some. This is the cash that has to pull its own weight and actually generate a profit.
So here's a super important point. Why these 3 items? Well, share capital and reserves, that's the shareholders' money. They definitely want a return on that. Long-term debt? That's the bank's money, and you better believe they want their interest. But look closely at what we didn't include. See the trade payables? We leave that out. Why? Because it's basically a short-term, free loan from our suppliers. It doesn't have an explicit interest cost, so it's not part of the long-term funding we're trying to measure.
Simple enough, right? Just add those 3 numbers together, the share capital, the reserves, and the long-term debt. And bam, we get our total capital employed, 2,439.52 lakhs. Step 1 is done. Easy.
Okay, on to step 2, WACC, or the weighted average cost of capital. Sounds complicated, but it's not. Think of it like a blended interest rate. A company gets money from different places, right? Shareholders, banks, and each source has a different cost. WACC just averages all those costs out, giving more weight to the bigger sources of funding. It's the minimum rate of return the company has to earn just to break even for its investors.
And this formula shows you exactly how we do it.
You can see we take the percentage of funding that comes from equity and multiply that by its cost. Then we do the exact same thing for debt. But here's a key detail. For debt, we have to remember that interest payments are tax deductible, which gives us a little tax shield or savings. We factor that in, add the two parts together, and that's our WACC. It's the real hurdle the company needs to jump over. So, once we run the numbers for our case study, for XYZ Ltd, we get a WACC of 12.07%, and that number is huge. It means the company has to make at least a 12.07% return on all that capital we calculated just to keep its investors happy. And with that, step 2 is in the books.
All right, last piece of the puzzle. We need our profit figure, and we use a special one called NOPAT, or Net Operating Profit After Tax. Now, this is not your everyday net profit. The whole point of NOPAT is to see how much profit the business operations made, as if the company had zero debt. It levels the playing field, letting us look at the core performance without the way the company is financed clouding the picture.
Okay, the calculation here can be a little tricky, so let's walk through it. We start with PBIT, that's profit before interest and tax. Then we figure out the tax on that profit. And then, and this is the most important part, we have to add back the interest we paid, but after we account for the tax savings it gave us. Remember that tax shield we mentioned? Since interest is a deductible expense, it lowers our tax bill. We need to account for that. Once we do that adjustment, we land on our NOPAT of 1,541.99 lakhs.
And that's it. We've got all three of our numbers. We've got NOPAT, we've got WACC, and we've got capital employed. The moment of truth has arrived. Let's plug them into the main formula and see if XYZ Limited actually managed to create any value.
And there's our answer. The EVA for XYZ Limited is a positive 1,247.54 lakhs. So, what does that actually mean? It means the company didn't just make a profit. It made nearly 12.5 crores more than the minimum 12.07% its investors were expecting. That is what we call true value creation. It's an awesome result, the kind of thing that makes shareholders happy and probably gets the managers a nice bonus. Okay, so we've cracked the textbook problem. But you might be thinking, why does any of this matter in the real world? Well, it absolutely does. Big companies use this stuff to make huge decisions. So let's step out of the classroom for a sec and see how this plays out in the real world.
Just take a look at this. We're talking about Hindustan Unilever, a giant, real-world company. And what do? They calculate their EVA and they put it right there in their annual report for everyone to see. They're using the exact same logic we just went through. So this isn't just some abstract theory for an exam. It's a real tool they use for planning their strategy, deciding where to invest money, and even figuring out how big a bonus their managers get.
And you know, while we're on this whole topic of creating value, I have to give a quick shout out to Eva's close relative, net present value, or NPV. The main difference is that Eva looks back at how the whole company did over a period, like a year. NPV, on the other hand, looks forward to see if a single new project is worth doing. But they're both driving at the same thing, making shareholders wealthier. In fact, you'll usually find that a company with a great EVA is a company that's really good at picking projects with a positive NPV.
Phew. Okay, we've covered a ton of ground. So to make sure all this sticks in your brain for exam day, let's do a final, super fast recap. Get ready, this is the Formula Flash.
First, our main event, EVA. It's your NOPAT minus that capital charge, which is your WACC multiplied by your capital employed. Got it? And for projects, you've got NPV. That's just the present value of the cash you get minus the present value of the cash you spend. Lock these two formulas in your mind, and you are going to be in great shape for performance evaluation questions. Keep practicing, and never forget, it's not just about the profit, it's about the value.